Friday, 6:14 p.m. A conference room on the 41st floor goes quiet. 43 hours earlier, this deal was done. Signed, champagne ordered, press release drafted and sitting in a folder, waiting to go out. Now the lead partner is staring at his phone, and the deal, $30 billion, is 48 hours from collapsing. Nobody outside this building will ever know how close it came. This is the story of what happens in the room when a buyout this size starts to break. To understand how a deal this large can almost die in 2 days, you have to understand what a leveraged buyout actually is. A private equity firm doesn't pay for a $30 billion company with $30 billion of its own cash. That would be inefficient. And frankly, no fund holds that kind of cash sitting idle. Instead, the firm puts up a fraction of the price, typically 20 to 30%, as equity. The rest is borrowed. That borrowed money is the leverage in leveraged buyout. It's also where the entire structure becomes fragile, because that loan isn't based on a handshake or a verbal understanding. It's based on something called a financing commitment, a formal promise from a group of banks to deliver a specific amount of debt at an agreed interest rate by an agreed date. Every projection, every return calculation, every promise made to investors, all of it depends on that one commitment holding exactly as written. When it doesn't, that's when deals like this one start to crack. 4 groups had something to lose in the next 48 hours. The buyout firm, the fund acquiring the company, putting its reputation and its investors' trust on the line. The target company's board, who had already told their shareholders the deal was happening, and now had to manage a public company quietly bracing for uncertainty. The lending banks, who had committed capital under one set of market conditions and were now staring at a different one. And the limited partners, the pension funds, endowments, and institutions who had committed money to this fund, expecting it to deploy that capital wisely. Every one of these groups was about to spend the weekend doing math, reading contracts and trying to protect their side of the table. The target, a logistics company with steady, predictable cash flow and almost no existing debt. Exactly the kind of business a buyout firm looks for, because predictable cash flow is what services the new debt load after the deal closes. The structure, $22 billion in debt financing, $8 billion in equity, contributed by the fund, and a small group of co-investors who'd been brought in to share both the risk and the return. The banks had committed to that $22 billion in debt 6 weeks earlier, when interest rates were calmer and credit markets were steady and predictable. But 6 weeks in financial markets is a long time. 2 days before signing, a piece of economic data landed hotter than anyone expected. Inflation, running above forecasts. Markets reacted within minutes. Bond yields jumped sharply. And the debt the banks had agreed to provide, on paper, suddenly didn't look like the same commitment anymore. Here's what almost nobody outside this world understands. Financing commitments aren't unconditional. They come with conditions attached. Most importantly, something called a market MAC clause. MAC stands for material adverse change. The banks providing the debt can argue that the terms need to be renegotiated, or in the worst-case scenario, walked away from entirely. 48 hours before close, that's exactly the call that came in. It wasn't a cancellation. It was something arguably worse: ambiguity. The lead bank's syndicate desk, the team responsible for actually distributing this debt to other lenders, said they needed to, in their words, revisit pricing before they could confirm funding. In this world, that phrase doesn't sound dramatic to an outsider. To anyone who's lived through it, it's closer to a 5-alarm fire. Inside the firm's offices, 3 things were happening at once, in 3 different rooms, on 3 different phones. The deal team was on a call with the bank's syndicate desk, trying to understand the difference between a small pricing adjustment and a full retrade of the entire financing package. Every basis point of difference mattered. On $22 billion, even a small change in interest rate translates into tens of millions of dollars a year. Legal was rereading the merger agreement's financing covenants line by line, looking for exactly how much flexibility the buyer had if the debt financing changed, and critically, how much financial exposure the firm faced if the deal collapsed entirely. Many merger agreements include a reverse termination fee, a penalty the buyer pays if it walks away. That number, in deals this size, can run into the hundreds of millions. The partners, meanwhile, were doing the math nobody enjoys doing under pressure. If the banks reduced or repriced the debt, could the fund bridge the difference with more equity? And if they did, what would that do to the fund's overall returns? And just as importantly, what would it signal to their limited partners about how this fund handles risk? This is the part outsiders never see. A $30 billion deal isn't decided in one dramatic boardroom moment, the way it gets compressed into a single scene in a film. It's decided in dozens of small, technical, overlapping conversations happening simultaneously, under a ticking clock, where everyone involved is reading the exact same contract, looking for a different answer to protect their side. By midnight Friday, none of the three rooms had an answer, only more questions. By Saturday morning, the picture started to come into focus. The banks weren't walking away entirely. That would mean losing a lucrative financing fee on a $30 billion transaction, something no syndicate desk wants to write off. But they did want to reprice the debt to reflect the new market reality, a higher interest margin and tighter covenants protecting their downside if the company's cash flow weakened. For the buyout firm, this came down to one question, asked a dozen different ways throughout the weekend. Does the deal still make sense at a worse financing rate? The team re-ran their return model. At the original interest rate, projected returns for investors were strong, comfortably above the fund's target. At the new, higher rate, returns dropped, but stayed within a range the investment committee could still justify to its limited partners. The alternative, walking away after months of due diligence, legal fees, advisor fees, and reputational capital already spent, carried its own steep cost. In this industry, a fund that walks away from a signed deal sends a signal to the market, and that signal follows them into their next fundraise. By Sunday afternoon, both sides had found a version they could live with, a half-point increase in the interest margin on the debt, tighter financial covenants giving the banks more protection, and a small reduction in the total amount of debt, with the buyout firm and its co-investors agreeing to contribute slightly more equity to cover the gap. Nobody got exactly what they wanted on Wednesday. Everybody got something they could defend by Sunday. Monday morning. The revised terms were signed. The deal that had nearly broken apart on a Friday evening closed, technically right on schedule. From the outside, nothing about it looked unusual. A press release went out, almost identical to the draft written the week before. A new ownership structure was announced. Trading resumed as normal. Business as usual, as far as the public markets were concerned. What the outside world never saw was 48 hours, where a $30 billion transaction depended entirely on whether a handful of people, reading the exact same financing agreement from different sides of the table, could find a version of yes that worked for everyone holding risk. The logistics company got a new owner. The fund's investors got a deal that closed, just not quite on the original terms. And the banks got a financing package that better reflected the market they were actually lending into. Nobody in the press release mentioned any of that. This is what large deals actually are. Not a single decision made in a single dramatic moment. Not a handshake across a boardroom table, the way it gets portrayed when these stories are told after the fact. They're hundreds of small, technical judgment calls made under real-time pressure by people who understand something the headlines never capture. The difference between a deal that closes and a deal that dies is rarely the big number everyone reads about in the press release. It's the 48 hours nobody sees. The conference calls at midnight. The covenant language read for the 10th time. The math run again and again until someone is willing to sign their name to it. If you want to understand how money really moves at the top of finance, the parts that never make it into the press release, subscribe. We go inside the room every week.